Okay, it is 10 a.m. Jeff, I know you have commitments, and so you have started the recording. Jeff Hussey is he's the COO of one of the companies, the biggest one, and operates everything and helps me with IT. So I want to say a special thank you to him. He's with family today traveling and took the time to make sure everything is operating correctly. Go ahead and mute your microphones. See the little microphone button up there. Hit the mute button for now, and that way we'll have a clean recording, as well as make sure that we stay on task. So we have a lot to cover this morning. Welcome to everyone. My name is Randy Taylor, and I've been professionally trading for more years than I want to admit, and I will say that, you know, my goal is that to avoid the pitfalls and mistakes that I had in my early years of trading. But I will say that experience is still the greatest educator. And so when you lose a chunk of money, you tend to remember how that felt, and you pay more attention to things as you're able to learn them and become more schooled at avoiding those in the future. But more importantly than that, although avoiding loss is important, especially right now, we're in a correction, and for a lot of people, it's extremely painful. So with that in mind, we will share some thoughts on that in the marketplace. But for today, mainly, what we're doing is we're talking about not only what I look for. I want you to be able to see not only what I see in the market. I want you to see how I see the market, because how is more important than just the what. I mean, oh, I see this on the chart, but how do I see that? How do I develop those skills in order to capitalize on things that are happening every single day, that are repeating patterns, that are setups that we can recognize? And while we are never one to say that we can time the market, we are in a position to be able to say we calculate entries, we calculate exits, we calculate stops, we utilize all of the tools that are available in order to limit risk, to hedge risk, to reduce loss, and preserve capital. And all of these things are extremely important when we're talking about building an equity, a capital account. And so I know we have a lot of new people, we have some intermediate, and I think we even have, some more advanced people. And I think that everyone will be able to glean something from this meeting today. So let me just see here. I got one last one that I'm going to do, and then the rest will just have to get the recording. Take care. And there we go. Okay, so the first thing I want to do is I want to provide you with some of the linguistics. I call this kind of the old Army linguistics challenge, because you'll see things on Twitter and different places. How is that? Everyone on mute.
How do I do my camera?
Let's see, this says 2. What is that?
It's you.
Mark Tramp. There we go. There we go. All right. Jeff, you got an edit. So the first thing in terms of the linguistic challenge, you'll hear statements like plant. And that's one of our favorite things that you'll hear. And plant is, make sure you're on mute if you just joined. Planting a stock. Planting a stock is when you are in a position to be able to recapture your initial capital 100%. And the goal is to be able to do that with selling no more than 50% of your shares. Many times you can do what I call juice that by utilizing options in order to further capitalize. Make sure you guys are on mute, please. Make sure you're on mute. Okay, we had a disconnection.
You hang up on there. You're still on there.
100%, then you may take a little bit more risk on in holding on to that stock. I typically will utilize options in order to either gain that same percentage that I would have looked at. Well, if I can get another $2 before I sell, I only have to sell 35% of my holdings instead of 50%. So I'll utilize some options on a percentage of the shares and work it that way. That becomes a higher risk. If I'm a newer trader, if I see a stock that I'm able to plant at 100% gain, I'm planting it because the goal is to plant stocks. That is a strategy that will pay off exceptionally well in your professional career and development. So, you know, why the mass accumulation strategy? So mass accumulation is the second thing, and it goes in hand with planting. The end result of a successful mass accumulation is to plant a stock. And mass accumulation is simply determining a stock that is undervalued or unknown to the major trading public that you believe wholeheartedly and have done the due diligence and study to validate that this is a stock that you want to mass accumulate. And we don't take those lightly because we're putting a tremendous amount of volume and money into those shares. We do trade those shares along the way because while we may see the value, others don't, but there's ebbs and flows. There's waves that occur in a stock. And so we like to take advantage of those by having additional shares and a certain percentage of shares that I might choose to trade either by selling them outright up 20%. I'm going to sell maybe 10% of those shares that I have. And then look to buy them back when they drop back down to what I have spotted as a major support line. Ultimately, that can go against you sometimes by the stock breaking on out and going mainstream. We saw that with WWR. I had 15% of my shares called out, and but now I've bought them back because the stock finished whatever was taking place in the politics, talking about looking at the mining community and all of those drivers that occurred that jumped WWR out, abated, and you add on top of that a correction in the market, and it's a perfect scenario for the shorts to take advantage. And so it brought it all the way back down. So patience is a key element to mass accumulation. So, you know, I think of mass accumulation and why I use this strategy and why it has been so beneficial to me and to many of you that have been following it is because it follows kind of an ancient text principle, and that is the parable of the sower. Some seed is going to fall on rocky ground and it's going to sprout up quick. Boy, it looks great, and then it just dies and it never goes anywhere. And so obviously we want to do our homework and try to avoid those. But if we plant that stock and then it just drops back down and it just sits in a holding pattern for a couple of years. And I think NEO, I'm not sure how long NEO sat, but it was it was a lengthy, it wasn't 2 years, but it was a lengthy amount of time, and people were questioning, should we be in NEO anymore? And what are we doing here? But the macro message of NEO was consistent, and I believed in it. And so I continued to pound the table, and we all know the result of that. So some of those, you get them planted, and then you move on. Sometimes you can trade them some more if you want, but the goal is to have a set of stocks that you have been able to plant successfully, recapture your capital, and move to the next one and do the same thing, because that is in itself spreading risk. It's not only spreading risk, it's increasing opportunity for max gain, because all you need is one. I just need one NEO. I need one Tesla. I just need one of those. But ultimately, when you have a dozen, 50, 100 of these, you are going to have multiple long-term major winners. And so SQ was one. I mean, we mass accumulated it. JD was one. We mass accumulated it. All of these stocks were just part. There were some that hadn't moved as much for a while. Some, SUM was one. We finally got a double and we cashed out, and it dropped down a little bit, but now look at it. Because infrastructure and building is just going rampant. And so that stock is now cresting new highs and moving, continually upward. CX was in the same sphere of some. That's why we mass accumulated it. And that was probably, I think, the longest dead stock, I would call it, where it just sat. And then what'll happen, just so I'm going kind of advanced technique here, but when you look at these stocks that are at lows and just trending at lows, what will happen most times before they break out is they squeeze downward. And they can squeeze downward for a period of days. They can squeeze down for a period of weeks, but they generally squeeze downward. And the reason they do that is, you guessed it, to get you out of them. They don't want you in them. So you got to believe, and you got to keep in touch. I talk to mass accumulation stocks. I talk to the owners. I talk to principal people within the company. I talk to unprincipled people in the company. I go to the wrong person for the right name. If I can't get someone that I can't find their name somewhere, I'll call in to the shipping department. And the shipping department, unlike the administrative offices assistant up there, the gatekeeper, I call them, isn't trained not to give you names. They're not even trained not to give you phone numbers. I've gotten phone numbers to direct lines to CEOs from a shipping department because they're not trained to screen calls. So you think outside of the box, and I like to talk to these people. So anyway, the strategy, it's ancient text. I get some that grow quick and die. I get some that grow for a period and then don't do anything, but eventually I get the ones in the good soil. And man, when they take off, isn't it a thing of beauty? And the more of them that you can get, the more you increase your odds. And it is a tremendous way to leverage your capital, to lower risk. I can promise you, everyone that has planted stocks, net-free stocks that have doubled during this downturn, they're sweating a whole lot less than anyone else that is just holding a bunch of equity, a whole lot less, because they've got all of these net-free shares of capital. And so 100% of that money is found money at this time. And it's a tremendous mental benefit and boost, which is another reason to do it. So I think that you will find, if you follow that process, you will find that you trade better, that you are much more mentally in the game, and that you also become more studious because you're putting more money into these stocks that you have studied, and or if you're mirroring, you are seeing some of the postings that are happening, and maybe I always recommend people do their own due diligence. So you can take some of those and when WWR is placed out there, and I was like, I'm going to be mass accumulating it for 2021. We started in 2020. We're mass accumulating, and here's the reason. Here's the thought process. I saw China is going to be restricting their mining operations, and they're going to be taking control as the evil empires tend to do. They want to control everything, and so they're going to control the mines, because those mines produce the goods that allow them then to produce all of their other economic opportunity. So of course they're going to the source to control it. Now, do they control companies as well? Well, yes, but in this instance, the thought process was they're going to, with a Biden victory, and I'm not playing politics, but I'm just saying we all know that China was petrified and terrified of Trump, and that Biden, they're not concerned at all with, and they think they have an ally. And so we knew that China is going to become more emboldened. And so that was the premise behind these stocks like MP, which we traded. I wish we had been able to get in on a mass accumulation on it, but it was an early runner. And so we weren't able to. We did trade it successfully on an options for, I think, 280% gain, but we weren't able to do the mass accumulation like we like to do. But WWR, we saw it's in the perfect space, largest graphite miner in the US that owns its own mining operation, and it's coming online in 2022. So to me, I thought we had this whole year to work ebbs and flows that we were seeing. Above $6, sell some or sell a covered call. Below around $5 or below, sell naked puts or buy shares. And boy, that was working exceptionally well. And then all heck broke loose, and we had to move to kind of an earlier than I had planned planting of the stock. And I guarantee most people weren't disappointed by that, but it is what happened. And I'll also say, what if you didn't plant? What if you said, well, I'm not going to listen to this guy. I'm not going to follow that philosophy. I'm just going to hold all these shares. And it went up to that place. Well, guess where you are right now? How's your mind? How's your mental standpoint seeing that stock in the fives again? I tell you what I am. I'm excited. I'm thrilled to see WWR in the fives again. And I guarantee you, all those people that planted that stock are totally excited, because I see them and they're messaging and doing naked puts again and doing all kinds of strategies again, back to the basics. And so that's why you do it. So I'm spending a lot of time on that because it is a critical element to you becoming wealthy. It is a wealth millionaire maker, is the mass accumulation, net-free planting of stocks. The next thing I want to talk about is, and I'm going to share these, I'm going to show these examples of these, goalpost trade. And all of you can participate right now. Right now, you can help each other become super wealthy by going out and finding these goalpost trades when they're happening instead of after the fact. Because when they're happening, you can really capitalize and make a lot of money. And many, many times, you can plant that stock within a day or two, a lot of times, if you do it right. So a goalpost trade is when you have a stock that has been in a downtrend period for a lengthy period of time, and then it generally will base and find kind of a dead zone. CX is a great example of that. And so you had this large, at the very end of that downturn, you had this large, big volume bar that comes up, this huge volume that's just dwarfs everything before it. And then what you really pay attention to is what happens after that, because what happens after that is what you're keying on. And when you see a stock that trades maybe 500 to 800,000 shares in a day, and suddenly it trades 20 million, 25 million, 30 million shares in a day, and then the next day it trades maybe 1 million, and then it drops back to 700, 500,000 again, right back into it. Well, that's common sense. What happened? Someone huge bought. Now, two things are happening during that. Shorts are covering during that. So because it's based at a low point and it's been basing and you get this huge volume spike, shorts don't understand what's happening many times. So they're going to get involved, and that sends that stock well above where the buyer was intending it to go. But that's fine because they don't care, because they're the super wealthy. They're the institutions, and they're accumulating this for much higher than what that bump gave it that day. And that's why after that happens, you don't see any volume. Now, if the next day you see it traded 25 million up and it traded 20 million down, I'm going to be very skeptical of that one in terms of the future goalposts that may occur, because that tells me most people sold out. All the big money was selling, because that's not day traders selling that large a volume. It's just not on a stock that's just one time. So what you're looking for is that initial goalpost, and then it drives into a longer period of time of nothingness again, with no volume being sold, and then it ends up with another goalpost. So you're looking at this and you see this goalpost on the left, and you see that just past it here, there's no volume. There's no volume selling right afterwards. So if they were going to sell on this gain, it would have been up here. They wouldn't wait till down here to sell. So this negative volume here, we don't care. We don't care about that in the grand scheme of things, because all this huge money that bought is still in it. They are still in it. Now, yes, is there probably 30% of that is shorts that it covered? Yeah, but again, we don't care about that. We care about the fact that the goal, left side of a goalpost potential is made, and then it becomes on watch. And the better that we can become at spotting these left side goalposts and then monitoring them, put them in an alert and have a volume alert set on your computer so that you can have it when it breaks that volume again. And it's pretty easy to say, well, you know, this day, anything above probably here, this volume day right here, you would want to have an alert on. Well, here's a day that it did jump. So we would want to pay attention to that as a potential goalpost starting to form, but it failed. It didn't continue volume. It just stopped. And of course, the stock immediately came back down as well. But you know what was happening? Same thing as over here. There was some big buyers going on, and some people that were, you know, thinking they're trapped, escaped and let it come back down. And all they did is stepped off the gas. So institutions will do this many, many times. They'll start a stock and stop it right here. Start it and stop it. It happens all the time during this period of accumulation. And then note this, here's the squeeze down. You see how it squeezes down into the second post. And of course, there it is, touchdown, right? So now you've got a touchdown. And so you don't know it yet, you haven't scored yet, you haven't made any money yet, but there is a touchdown right there, opportunity being played. And so you're entering, you're watching it that day. And yes, you could enter if you wanted to. Once this volume is creeped up above this day and you see that it's all green buying going on, yeah, I would probably jump in if I was fortunate enough to see that day. But guess what you would be doing? You would be selling as that thing really jumped up. You would be selling a percentage, not all, but it almost doubled. Look at that, right? Oh, it did double. So it doubled from its low there. Not quite. No, it went from 58 to $1.08 or $9. So it got close. So you know you're selling that, but when it jumps back down and it collapses back in, you have this huge volume. You don't care about it like you did this time. You're buying it. You're buying it. And the next day, when you see the volume is down here, less than a fourth of the previous day's volume, you know. You are confirming your hypothesis of a goalpost trade. And that is that this thing is about to take off. And so The next day, oh, something else that you'll see on this chart. I mean, again, how am I looking at it? Not what I see, but how I see. So I am seeing a goalpost move now. What else am I looking for? And how am I determining what I'm looking to do with this stock? I'm looking to my left. I'm always looking back to the left, because wherever it's come from, it is to return once a stock reverses. And the first level of return is to complete the cup. A cup formation is what is going to happen first level. Now, it may never do anything beyond that cup for a period of time. That may be the end of the run for a long period of time, but guess what? You're net free. Anywhere you're buying in here, up to 80 cents, when that cup completes up here to $1.70, you're net free. You are net free. And so you don't care. You don't care if it takes 2 months to continue breaking out, 6 months, I don't care. I plan it and I move on. I set some alerts on it. Sure enough, in case it does break out, I want to be observant. I'm always thinking, you know, how would I utilize options on this trade? Does it have options? Some do, some don't. That comes into part of the thought process of just how many shares I'm willing to buy of a goalpost stock. If it has options, I can be very aggressive because I can mitigate loss. Many times, if it jumps up from 60 cents to $1.20, many times you have options out there that can get you $2, $2.50, even $3 that'll bring you 80, 90, $1 in premium. And sometimes $1.20. You can literally have $1.20, a net free premium in covered calls to your stock with an upside of $2, $3 when they're really on this hot move back up to this top here. Those premiums really spike and you could take advantage of that. So those are considerations that you want to always have that in mind. You always want to be planning and thinking, well, what if that happens? What would that be? And so all of those come into your consideration. So this was one that was a great, you know, CIDM. And many of you are in it. Many of you have already planted it. And so here's a situation where we were buying, right? We posted in there, hey, here's they are growing their content. They're not that company that used to be in theaters that had the reel go across and just showed little commercials and upcoming feature films. They had moved into content development and delivery, and they had quite a robust library. So we studied it, and I called and I asked them about what their future plans were. And I asked them who their major distributing points were going to be. And I became a believer. And so it became a mass accumulation share. And we were accumulating like crazy. And sure enough, it just bounced and just took off. And it jumped up here to $1. Let me throw this on. $1.43 was the high. Now, here's another lesson. If you do not have a platform that you can pre-market and post-market trade from 3 a.m. in the morning Central Time to 7 p.m. In the evening, then you're not a trader. Okay, you are not a trader. You may think you want to be a trader, but you're not a trader. You have got to have a platform that you can trade before and after hours. Why? Because many times these hyper moves occur pre and post market. And here's a situation where CIDM jumped up in the pre-market up to $1.43. And if you weren't awake at 5 a.m., actually that's 4 a.m. our time, if you weren't awake at 4 a.m. or had a preset sell to sell a double, you know, would have been, I think we bought the initial one at 50 cents. Well, a double would have been a dollar. But if you watch that and you see these spikes, you could sell anywhere along the way to get your money back. But guess what? What if you waited and said, well, I can't trade until the market opens? Well, here we are coming into the market open, and you're back down here at $1.15, and you're just begging for that thing to open. And in the moment that it opened, it just goes straight down. It goes straight down. It had a volume attempt right here of trying to gain a foothold, and that I was watching that extremely closely. But once it failed, then what happens is it tried to bounce it, and that becomes resistance. So that's something we'll talk about in a minute, but it became resistance, and then on down it went. And of course, it dropped all the way back down for us. I've got that chart somewhere. It dropped all the way back down, and I had targeted 60 cents to re-enter shares again. And sure enough, it hit just below 60 cents, and a bunch of us were buying like crazy. We probably prevented it from flashing down below 58. I think it may have hit 58.7, something like that. But we bought it, and sure enough, it ended up going back up. And of course, it didn't stop that time. And it ended up being up there upwards of, I don't know what the high has been recently, in the 250s, somewhere in that range. And then it's pulled back some with this correction that we have going. So if you can't trade pre-market, if you can't trade post-market, you're not trading. You're not trading professionally. You're at the mercy of the institutions, whereas you can play outside of institutions many times, and this is where day traders are leading you. So the best platforms, I see that question. I'm sorry, I'm not seeing all of those, but I did see that one. I use IBKR and Thinkorswim are two, and I have one is my primary is IBKR, interactivebrokers.com. And please, if you're interested in that, email me and let me send you a link, because the money from the link goes to charity. So IBKR will pay a percentage to charity for people that sign up through that link. But IBKR that's where this chart comes from. That's where everything I'm sharing with you today comes from. But I have a backup platform because, as we saw last year, there was a little glitch when IBKR had an update, and it created a situation for a few hours there. I think it was more than a few. It was quite a few hours. First time that's ever happened, but you don't want to be dead in the water. You don't want to be able to, especially if you're large in the market, you cannot be in a situation of not being able to trade. And so now you may ask, well, what if I have all of these shares in this company, in this IBKR platform? What am I going to do in the other platform? Well, you could do all kinds of things. You could sell a covered call naked, and then utilize your shares, and it's a transfer process. It would be a drastic situation, but generally, as markets are trending, you wouldn't. But if there's a situation that would hit that you just had to take action, you could buy a put. If you said it's at a net free, and I can't trade that stock on whatever platform I am, well, I can go in and I can buy a put, and I guarantee myself then a net free exit of those shares. And so there's a number of things that you can do, and that's more advanced. But have these platforms because they're 99.99999% uptime, and you don't have to worry about that. Okay, can you see it? Can you see it? So this is obviously a different goalpost move, but it's a goalpost move. And what you have is you had the goalpost move ignited a stock, and then it traded back down, and you had another goalpost move. And this is NETE. So anybody interested in buying NETE right now at $6 or $7 after that goalpost shot? And I think you'd be okay if you look at the stock price. You'd probably be good with buying the goalpost move from this to here, but it's a little bit of a different one, and it's a little bit of an unusual one, by the way. But it showed also just how strong the underlying buy is. And again, there is no sales. In fact, there was buys, right? And that's why it went up. And then here, there were buys. So people were buying up here, and this is pretty big volume. And I'm sure a big percentage at this point is day traders. But that's institutional buying, folks. So you're talking 35+ million shares. That's not a day trader. Okay, that's not a bunch of day traders in this instance creating that on a stock like Netted. Now, if you want to talk GME where there was a strategy, sure, there's a lot that went into that. But in terms of this, what you see is this huge volume, and then again, no one sold. Those big institutions don't care. They don't care about losing $2, $3. They don't care. You freak out when you lose 50 cents. They don't care if it moves $3. And that's something that you got to get in your mind. Don't sweat it. If you see this, trust that process. And now if you have options that you can assist yourself in these, by all means. I do it a lot of times. I'll go into a stock, and if I bought this at 7 and it had the options at $10 that I can get maybe $2 by going out 2 months, absolutely I'll do that, because I'm net free on those shares at that point. It falls into my strategy. And then if this happens and it comes down like this, squeezing down before the big move up again, and that's a, boy, they're good at it, aren't they? Aren't they great at it? Squeezing down and driving you out before they make these big moves. They do it. This is their life, and that's how they work. Institutions are mean. They do not like you tagging along. So they're not an OA1. They don't say, mirror my trade, come along for the ride. No, they don't want you. They do not want you on their trade. So they want you here. They want you somewhere here. They don't want you here. So they want you taking them upward after the fact. That stock, you know, it's moved up extremely nicely. But again, no sellers, and always buying. No sellers. How do you look at stocks? How do I look at trades? That's how. That's why I'm like, when people are, if they gripe about a trade, I'm like, I don't care. I'm not worried about it. You know, do your own due diligence. This is what I'm doing. This is why I'm doing it. And this is why it pays off most of the time. A large percentage of the time, it always pays off for us. So can you see it? You need to see it. There's another one. This is BIOL. Okay. So you had this huge goalpost, came down, right? As long as I don't have over 50% selling, I'm there. I'm watching that stock, right? So here it came, you know, no volume again. And then it hit this period where the volume starts increasing. And to me, that's extremely important, because that tells me the bulls and bears are starting to fight it out. They're starting to duke it out a little bit here, because the bears have been so having fun. And this stock came from way up there, just drop forever, it seems like. And so the bears are like, no, go back into hibernation. And so you have this fighting going on, and the bulls know what they're going to do. We still don't. And we're not buying anyway, and we're not even paying much attention to this until this happens over here. But here's this squeeze down, and then a move up, and then this slow build. And when you start seeing these patterns of these slow buying, and it's not a big volume, but boy, those institutions, they're just chipping away, because they know they're near lows and they're not going to get much better opportunity to buy. So if you weren't already looking, well, then what you would do is you would come back in terms of volume. You can look back. There's screeners that you can look at volume, and you look for you know, anything like, start with 20 million shares. So screen for anything 20 million shares or more, and all the stocks come up. And maybe you find some that have just the left side. Those then go into your watch list. And so what you do is you come down here and you take their average volume. In this instance, you would have, it's not as clear as a lot of them because of this bull bear fight that was going on. You would have to come in here somewhere. The mean average of these, this volume here, 30 million shares, which is quite a bit of shares, is when I would start paying attention, have an alert set. And it would have gone off right here, okay? And that's boy, that looked like we were going to goalpost, right, all the way back up. And you know, frankly, I probably would have bought. I probably would have bought some here because of this entire pattern of seeing this going on, seeing that pattern going on, and all the time, anytime it gets down here to this major support level, the bulls are just nipping away at it. And that's not day traders. They're not patient. That's bulls just sitting there day 1, 2, 3, 4, 5, 6, 7, 8, you know, 9, 10, just day after day, chipping away as it's sitting down there. And then it comes back down here, and they do it again. They just start chipping away at it. And then you have this move. So yeah, I probably would have bought. I would have bought somewhere in the probably in the 33 to 35 cent ranges as it passed through the volume. I probably would have been buying, and then I'm going to be watching it because it didn't give a full goalpost, and I probably would have celebrated this, the squeeze down. And I wasn't watching this stock. If I had been, we would have been, we would have been very wealthy off of it, because, this squeeze down here would have been a perfect opportunity. Yes, I do. I look at the 1 day for goalpost moves. 1 day. So yes, there can be some 2 days, but generally it's a 1 day. And the reason why is they're trying to chase day traders out by sending it up and then shooting it back down. You'll notice that most of these, when they shoot up this line right here, it comes right back down. It's so easy to shake a day trader that thinks that they missed out. But if you are seeing the big picture and the how of what you're looking for, then you're not. You're buying, you're adding, and you're going in hard at this point. So yeah, I'm looking at a 1 day chart. Now, obviously the next day, sometimes they'll sit 2 or 3 days before they'll go in, but this one didn't. It immediately retraced, and that's another thing in terms of education. When a stock retraces its attempt at a breakout move, you go. You don't say, well, I wonder if, no, you go, because that is one of the strongest moves in the market, is when a flag here is formed, a technical signal has been given, and then the next day, as soon as it topped this day and this day, it closed down here. As soon as it topped here again, you could buy 1 million shares and be very confident. And then just wean, just trim along the way. If you aren't used to it, you could just trim along the way upwards if you want to go with that strategy. But strategies are your strategies. But in my book, when this happened, that was a goalpost move. I'm looking for a much larger return, as are those institutions that bought all those shares. They're not doing it for 60 cents, folks. Okay, they're not doing it for 70 cents. That's not why they bought what, 80. 180, 250. That's not why they bought 300 million shares. Okay, and that's what in net they have. They have 300 million shares. You think that they're looking for a 30-cent gain? You think that's what they're in this for? So think about it. Okay, ask yourself these common sense questions. They'll help you. All right, the next concept is Model T. Model T is a phenomenon, and I use Taylor. It's a sideways T. So you have this, and then you have this, and I'll explain how that works. Okay. So Model T is a simple process, a phenomenon that occurs when a stock tops out or bottoms out. In this case, it tops out and it starts to break down. It will always drop down to, I say always, it's way above 90%, and you will marvel at how many times it happens. But it'll drop down to wherever it came from of a mean. Now, I'm going to use this after the fact. Okay, so we have this big drop down and it bottoms. So we have a very clear signal that was given here of a flash down, and I call that a tricksy move. This right here is when it goes below the previous day on a reversal. It flashes down below, and if you had watched this live, and I was, because I always generally have SPY 1 minute open on the day, so I'm watching that very closely, and as soon as that move happened, I started buying into the stock just to trade it on a day. Now this is a 1 minute chart, so it happens fast. And so I'm going to use a baseball analogy. The way they train batters is they start by throwing a 60-mile-an-hour ball, and then they raise it to 70, then 80, then 90, then 100, and then they'll actually go beyond what a pitcher actually can pitch, because your eye discipline becomes part of your process. Same thing. You will have this same pattern on daily charts, and I'll show you a couple, but you'll have the same pattern on daily charts, which is obviously happening much slower, so it's much easier to trade. But on day traders, they're going to trade this because they're looking for this Model T. And what it is, it's the top, whatever that number is up there. So it'd be 368.15 to 20, actually 368.12. And then whatever the low was, okay, which is down here, and you add that number, okay, you add this number, whatever that is, to that number, and you divide it by 2, okay? And whatever that number is where you can count on 94% plus of the time it reaching, no matter where it's going to go afterwards. And that's important to realize. I don't know what it's going to do after that. Now, I'm going to be watching macro trend, obviously, because macro trend, if it's upwards, if the stock market is in an upward trend and not in a correction, then I'm going to stay with the trade much longer than I normally would. But on a day trade, I guarantee you, these day traders out there, and they know this move. They don't know what it's called, but I call it a tricksy move because it's simple. And I like to use stupid names because it makes you remember them. Because when you see this happen, that's the market makers shaking you very quickly. Anybody that was like, well, here's the low, and I'm buying, anyone that's bought through here, and they're like, well, I'm just going to hold it and see as long as it doesn't hit a new low. They flash it, hit a new low, and immediately reverse it. That's when your confidence in your entry is occurred. And then you get confirmation when it trades above this candle. So the moment it trades above it, you don't care about the moves in between here and the Model T. You know, you're trained to expect a Model T. And sure enough, it flashed above it. But then you had, look, exactly that tricksy move, exact opposite, mirror image of people thinking it's breaking out further. And then as soon as it came back in within this candle, you better be really either getting out or trimming hard because generally that's not a good sign. And sure enough, it failed quickly back below that and came back down and double tested. Now, what else do you see? Well, you see that it came back and did a double test with another flash down and came back in within the range. So again, day traders are going to be trading that. Okay, it's established an attempt at holding a bottom. Clearly, you can see it. Okay, so once that's happened, what does it do? It makes it back to Model T again, but this time Model T has become resistance. And isn't that interesting? And you will, again, you will be blown away how many times that you see that happen. And when that happens, that tells you that you probably have a situation that is going to be a downtrend. And so you want to exit. If you didn't exit, you want to exit. If you traded it again, you want to sell 100% this time. You don't want to hold it, okay? So Model T, what else was up there? I was like, okay. Okay, here's another Model T on MGNI that we traded. So I had a message from an ag that, you know, he was in it. He had sold like 20%. He hadn't, it was net free, but he had only sold 20%. I was posting that I took covered call positions on these, on all my net free shares. I took about I think a 35% position of net free, with covered calls. Well, you know, I didn't like this action up here. Okay, it couldn't break out. It continued to try to push and break out, and it couldn't. So as soon as it starts this breakdown process, I'm going covered calls. I didn't catch the exact top. Okay, I was 50 cents to 80 cents away from the top and entered that call. And so it drops back down, and guess what it does? It Model T'd. Okay, so from the top here to this bottom, it came back up 50%. You add the two numbers, divide it by 2. Look what it did. Hello. So I'm sitting there like the cat that ate the canary, understanding, you know, seeing that happen. And now I'm watching that closely. If I had the day chart on this, you would have seen the Model T drawn, because I'm watching that very intensely to see, is it going to be lost? And so when that Model T started to fail, I bought puts on the stock. And so I put $25 puts on and had the covered call in place as well. Well, sure enough, it started dropping. Well, that individual you look at the volume too, but that individual contacted me on this day here where it jumped back up and basically mirror traced, and this is called an engulfing candle. So when you have a candle down all the way, and it could be the opposite up here, you had same thing, you have this candle went all the way up, and then you had this candle come down. It didn't come down all the way, but that's, to me, that starts my process of looking at, are we reaching a top here? Because an engulfing candle is typically, you know, going to be bearish. It's going to be bigger money is starting to sell out on these spikes that occur, and that's why these spikes occur and then they reverse, spike occur, reverse, and can't break out. So you're paying attention to that. And so here we have an engulfing candle. And so he's asking what to do there. And I said, well, what I would do is I would buy a bunch of shares right here, and I would be trading towards Model T. And so this happened intraday, folks. All of this is happening intraday, and it drops like a rock, and it reverses, and he bought quite a few shares. And so it came up, it Model T, here, look at this, here's your low, here's your peak, here's your Model T, boom, 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 there it is. If you drew a line up here, down to the base, and you drew it sideways, guess what you would get? You would get right here, Model T, okay? It squeezes below that, all right? And, but you believe this volume. And so this is the how. This is the how you trade. You believe the volume, and that much volume trading is a bottom, okay? When you have that much volume trading on the minutes, that is something that is not going to be let go lightly by the bulls. And so I would hold through this. Now, you probably sold some at the either at the peak here or from a Model T as it moved back up. And isn't it interesting? Look at this. Here's this peak, here's this low, here's Model T. So these boom, 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 boom. Oh, missed it. So these are repeating phenomenon, and that's my point. They're tradable. They're things that you watch for. And another thing that you'll do is there is these wave Model Ts. So that's the ones that we're seeing on the minute chart. And then there's more of a macro Model T that happens both within days and also within the macro market of Model T. And what I mean by that is if you took this low here, okay, and you took, I'm sorry, I'm on the wrong chart to explain that one. All right, so anyway, you're trading to this Model T here, and sure enough, it reached that Model T. So he was able to exit those shares at achieving Model T. It blasted past that, and you know, went up and then reversed and came down. Now, eventually it went up and it got that news, right? It got the news that just sent it up to the moon, which is why it's important not to let go of your net free shares. Now, if you strategically did I was able to, because of the action that happened, I was able to buy back my covered calls. I mean, I'm sorry, yeah, my covered calls and my puts. I was able to do that based on my experience and knowledge of seeing this, okay? When I told him to jump in, this is when you want to be buying, I was taking the exact other action. I was taking my covered calls off the table. They had dropped down very nicely. Yeah, share value had dropped as well, but they're net free. Another beautiful thing. What do I care? They're net free, okay? So it takes all the pressure off. I love trading without pressure. So I'm now convinced. I'm looking for Model T. Model T gets achieved here. And yeah, I got caught. I admit it. I put 15% back on covered calls at Model T, and I thought I was the brilliant guy, and I was for about 4 hours until the market closed, and then the news hit, and it sent off to the moon, and I made $3 a share more instead of 20 on those 15%. Okay, that's life. I don't think anyone's going to complain about that, frankly. All right, Model T, there's another one. There's SPY, okay? Again, these phenomenon happen. They happen every single day. The last seminar, at the conclusion of the seminar, the next day of trading, you would not believe the number of people that were messaging and emailing saying, I just scored X amount on a Model T trade, or I just entered this stock long because of a Model T that was achieved on a daily chart. I'm telling you, it's my number one. So I use three different main things in charting. I don't have all of these huge programs that are running like all of these people that you know, spend every waking hour. I have three, and this is my number one, is the Model T. And the reason it's my number one is because the percentage is huge of that repeating, and we have made a ton of money off of that on the daily charts, more than the intraday, obviously. So PLTR, here's an intraday chart. So we called the pivot here. We had said enter the stock. We started buying, we bought as it came back down and retested. So I missed it here. It jumped up and it came back down to here. We entered. It did a flash down, and we bought along the way. And again, the reason why, here's the reason why. You see these volume posts, you gotta get used to looking at all aspects of a trade, and volume is the number one trade. Okay, number one thing is when the big fish are swimming, they can't hide themselves on charts. They cannot hide themselves. It's the only place that you can see them unless they have to report what they're doing, and that's always in the rearview mirror. Doesn't really help you. Maybe if you're in the stock like PLTR, Kathy Wood bought, and the stock took off that time. Okay, great. And that was this stock. So we were buying, and at the end of this day is when Kathy Woods came out and said that she had bought and it took off. But we were buying because we had, number one, if I brought up a, this is an intraday, 8-minute, 21 and 50-day, 50-minute average, but you would, on the daily chart, it was coming below the 21-day moving average, and that was our target goal. So in combination, and that's, you need all of these things are working together. I'm looking at the daily moving average. Is it below a key moving average? I'm watching the macro volume on the charts. Has volume been increasing, decreasing? Has it been selling hard with high volume of red, and now it's coming down and you're seeing less and less red? And I'll show you an example of that in a minute, showing that sellers are basically petering out. The buyers hadn't started, but the sellers are not selling anymore. Stock continues to go down because the buyers aren't buying. Okay, institutions aren't buying. But in this instance, what do you have here? You have this huge red candle, but it reversed. It couldn't go lower, and it reversed. So now it jumps back up, it comes back down, and it had another huge candle, okay, another big candle, and it couldn't get any lower before it started reversing. So whether you were buying in here believing, hey, I'm below the 21, which is what I was doing, we were posting to buy, we put it on Twitter and other places, buy, you know, entering PLTR. And sure enough, you know, we got this, we captured this in this move. I mean, it was a strong move back up. You ended up from here to here, okay? So you had a pivot pause that started back down, okay? And so when you're watching this in real time and you see this right here is below these, then you're like, okay, I've got a pivot now that's happened, and now I'm on a Model T watch. That's when you start your Model T watch, is when that happens right there, okay? So now I'm Model T watching, and it comes back down. I take this 25.13 low, 25.68 high, plus, you know, add those together, divide by 2, and that gives you 25.40. And as soon as it got to 25.40, I tweeted, I said, if you missed, if you weren't here, if you weren't able to get into PLTR, because now I've seen this. Now I've seen the big boys are now pledging, right? They are going in hard on the stock. So I'm a 100% believer that I'm right on the 21-day moving average is going to hold. We're flashed back above it. And so I'm totally convinced. So I tweet, if you missed it, if you weren't around, here's you an opportunity to enter PLTR. And it was, okay? So if you were a late entry, and let's say you wait and you want to see that Model T and then how it responds to go in, that's fine, especially if you're doing it on a daily chart. But on a 1-minute chart, these things happen fast. So you have got to be prepared. and I'll show you how to get that information very quickly on your systems that allow it to do so. There's your Model T on a daily chart, NET. And everyone that's been following knows that we made a ton of money on NET off this trade right here. Okay, so what we did is we traded the pullback. And so when Model T came back from here to here, Model T is right here, and some of those look longer, right? So it's a longer period. This is the look of the T, and it was a longer period on the dailies, but sure enough, it came right here and flashed. And notice two things. It flashed below Model T, and look what else it flashed below. Okay, there it is. There's your moving average. Okay, that's your 50-day moving average on net. So it's not going to let go of that 50-day moving average voluntarily. And so we entered it based on achieving Model T. We didn't enter the stock, we entered calls. Okay, we went with calls, and I believe that we went with $80 calls at that time. And you know, and it shot up to above $85, $87 for our exit, and it hit our target. Some people sold like 50% and held the other 50 to see if it jumped up, and then when it did, they sold on out. Some held a little bit long and ended up making back to 100% ROI. But anyway, it was a very successful trade based on those variables. Okay, so I looked at all of those variables, and that's why we entered that trade. Okay, now here it is blown in when it was occurring, but this is a 5-minute chart. Okay, so you see that big volume that we talked about, and on a 5-minute chart, it tries to go down and it can't. It held this. That's 5, 10, 15, 20. That's 25 minutes. Doesn't look that way on a minute chart, does it? That's why I always have a 5-minute chart on a stock that I'm watching to determine my entry. And reason well, Randy, why are you watching it? Well, because I want a new net. I've been in net. It's a net-free trade that we've been in net-free anyway. But I also love trading stocks that I intimately know. And so when it came back down to that 50-day moving average, I was on high alert watch for it to break down below that. And so it was right here. We're below the 50-day moving average. And then it did the tricksy move. All right, you guys know I just love that thing. All right, so when that happened and it reversed up, I'm a huge believer on the 5-minute. But what was I seeing in the 1 minute? Hey, let's see. Do I have the net? I'll try to find the 1 minute chart, guys. Oh, that is the 1 minute here. Okay, so on the 5-minute, you can't see this. I'm sorry. If you have the 5-minute chart, let's see if I have that 5-minute chart. No, I don't. I don't have it. Okay, no problem. So yeah, this was 1 minute. If you were on 5 minutes, you wouldn't have been seeing this. Okay, you wouldn't have seen this. So by being on a 1 minute chart, in the 5-minute chart, you're sitting there, and yeah, the 5-minute chart would have had this encompassed in one frame, but I'm seeing every minute that happening. Okay, and I saw this big sell that couldn't break it. It couldn't push it down, and I see the volume start to edge up and buy, and I'm like, if it doesn't lose this, if it reverses off that, I'm going to call a pivot. And when that happened is when we said, hey, net has pivoted. We're going to enter these options. And then when this volume hit here, I was totally convinced. So it hit its tricksy move. It went up to here. It came back and Model T'd, right? And then it sort of just held for a day, and then it took on off upwards. XL. Oh, what am I trying to show on XL? I'm sorry, I got multiple things I'm looking at here. So this is the 21-day moving average. I've been watching for that. You had a Model T that was occurred from the low here up to the top. Your Model T was actually somewhere in here. All right, so it had been achieved. It's below it. It crosses the 21-day moving average. Okay, the next day it crosses it hard with a flash down and immediately starts up. So we entered the shares there, and that's I think the same day that we tweeted this, that here it goes, I think was the tweet. that it's going to go. Scott, who's a really good trader. I can't remember his last name right now. Scott, oh, he's on CNBC and everything. Anyway, we do some things. But anyway, that he tweeted when it hit about 2250 that he thinks it's going to take off, and sure enough, it did. Okay, so here's net. There's where it looked like before and after. I think that's a repeat slide. So that's where we entered. That's the day that the entry was made of the calls, and then there's the result. It went back up, and look where it came back down to. It came back down, and we were actually able to trade it again. I didn't trade it as heavy that time, but we did trade it again for a good gain, because after this, it did go back up above 83. SDC. There's the move intraday that I was waiting for, and there's I'll show you the chart on the IBKR system of why that was important. It crossed a moving average that I'd been targeting, and so that's why we entered the calls that ended up jumping up to above $14, and I think we ended up making nearly 300% on that trade. But when you have this huge reversal candle, you just can't, and it's crossing a daily moving average, you take your shot at that time. That's when you take shots. If you see this randomly, I don't think as much about it. It's in concert with everything else. What's the macro market doing? What's the total volume on the stock doing? What's the news? So I'm looking at the news cycle on it. But I was waiting for that to happen, and also what you'll see is a wedge pattern that was formed that was made that, frankly, probably one of the easiest trades that I've made all year. So this is SDC. We traded it here, okay, one time, but we didn't trade it very heavy. But on this one, we traded extremely heavy, and I know some traders went like 500 calls that I know, and so great, awesome. They made a ton of money. I was gone here. I was gone, and that's why. And y'all, some of you remember I posted this because that would have been a clean entry, because the moving average had been moving right along, okay, right along, and it flashed below it. And it would have been a beautiful entry again. And I know at least one of you guys did, because you kind of rubbed my face in it. And I appreciate people like that. Love you a lot. But here's the trend. So you see this trend line here, okay? And you can have a top trend line as well, which can help a predetermined exit. And then you have these wedges. You got to wedge down into this line, okay? You got to wedge down into that line. These are my tradable spots, okay? So that's the essence of the wedge trade that I was looking at. Skills, same thing here. Something that I want you to add to your arsenal that happens more times than not. If a stock, skills had been trending down for 7 or 8 straight days. And when that happens, and this is when it opened up, it immediately starts falling. And so it's now crossed right here. I'll bring up a daily. It crossed the 21-day moving average. So it had been well above the 8-day. It crossed the 8-day. It was falling below the 21-day. And then what you look for is this acceleration move down. And when I'm always looking for acceleration moves, because at the end of a long, painful drop of a stock, generally the market makers are going to make it that much more painful to end it and accelerate it down to make people think it's off the cliff and boy, I better get out of this thing. And that's the precise time when they're going to reverse that thing. And if you notice, it Model T'd, right? Is that not beautiful? It Model T'd. So if you said, well, I'm not sure about that, but look at this volume. It couldn't go any lower. And then it Model T's. It couldn't go any lower. Okay. What are you waiting for? What are you waiting for? on a stock that had been trending down for days and days and days, and it crossed a key moving average. What are you waiting for? So what same four things happened on this minute chart? Well, it went from a Model T from here to there to there. It went from a Model T from here to there to there. Okay. It went from a Model T from there to there to there. So you had 4 Model Ts that were going on that trade. Is that not incredible? And they were almost so. All right, guys. First time we've lost power in I don't know how long. Had to wait for the generator to kick in. Sorry about that. Let me get back where we were here. Okay, so we finished with skills. Yeah, go ahead and laugh it out. ERCOT, put me in the lawsuit. At least it's not sub-zero. All right, so yeah, you can see four different Model Ts occurring here that you're tracking, and that's what I'm looking at. I don't know what people are looking at when they're watching their screens during the day, but that's what I'm watching. I'm watching those Model Ts because, frankly, that's telling me the ebbs and flows of what the market makers are going to do. Once those are achieved, they either fail or they continue. So very important. Uber, same thing. It had been just dropping. Note the acceleration in the move. Okay, so you had this move that was like these moves, all these down moves that had occurred. So it had another one, but then it had this accelerated move followed by boom, right? This big one, and the volume just ticked up minute over minute. So this is where it crossed again. This was crossing a 50-day moving average. So I was very confident in Uber coming in there. So it dropped down. It Model T's off of this move from there to there. There's Model T. It had continuation. It drops down and Model T's off of this, and then you see that. And this is one of the most glorious things that you'll ever see, and that is a build. Okay. When you start seeing that build, basically a squeeze is beginning on a stock. And so does it mean they'll always continue on? No. Apple fooled us, would be an example. No audio. Can anyone, y'all can't hear me? Okay, we have some people that can hear. I don't know why. Maybe test your volume because everyone else says they can hear. Okay, sorry about that. Or maybe re-sign in. But anyway, yeah, this was a great trade for us on options. We made a great score on it. Notice that after when I say that you see this build, okay, look what it did. It came back down and double bottomed. I mean, very close to double bottom. But when it holds that double bottom, if you're already committed to your calls, why would you sell? Why would you sell out of your calls? In fact, if you sold some on Model T, and depending on how many I buy, I'll do that sometimes. I'll sell a small percent on a Model T just in case something like this happens, and then I'll just buy them back. But so I don't day trade, but I will trade that Model T from time to time, and especially how. Again, not what to look for as well as how to look for. What am I looking for? Well, once I have this pivot, once I'm committed to enter, once I have a Model T has occurred, the natural first thing that I want to see is a cup, a V, okay, complete. So you have here, I need here. So you had this move, and once it got up to here, now I've got a completed V recovery. If it's a cup formation, I look for a completed cup formation, and that happens here. Now, note it didn't quite finish here. It got close, right? But here, we've got a clear completion above the left side. So that's always very strong when you see that. Okay. So even though it did this trend down, then this is an intraday chart. So there's ebbs and flows throughout the day. And a lot of shaking was going on because Uber was fixing to take off for a pretty major run above $60. And so that's why these market makers, man, they do not like you. But as long as you're watching the things that are important, the daily moving averages, the volume over, the macro trend, all of those variables, you'll come out on top many times more than you will lose. WWR. This is an example. It's a little bit different than a acceleration move. This is on a daily chart, and you will have acceleration moves daily on some stocks where they just drop like a rock. And in fact, right here, you see WWR very quickly, day over day, accelerated downward. So it hit a Model T, by the way, from here back to over here. It hit its Model T in here, and it tried to hold it, but it continued on downward. Anyway, once it started back up here, it starts this stair-step move, and that's what this is called. It is called a bullish, ironically, stair-step move. And what it means is that the bulls have firm control over how much the stock is going to move down. And they are buying along the way by simply taking their foot off the gas throughout the day. This is a classic tactic of accumulation. I do it, by the way. I can't create those patterns. Okay, institutions can create those patterns. I trade those patterns, but they're stair-stepping by simply releasing the break and not showing their hand, but buying all the sales that are occurring downward. And a lot of times shorts start piling on, thinking I got you, and they're just absorbing them, and they're tricking those shorts into volume selling, where they don't have to create anything on the chart volume-wise to the upside until, okay? So what'll happen is I did this in everywhere, Twitter, everywhere. I did this. When this came back up and broke the 2-day, it was a classic signal. Anytime you see the stair step intraday, by the way, this works intraday as well, a stair step. Now you'll see some more angled downward stepping that goes on. Not the same. Has to be at this kind of an angle. It's flattening out almost of an angle. And if you notice, it got really flat here, but it bottoms out and then it comes back in. Well, that day is when I was like, you should start buying, you should start selling naked puts. This is your time. The signal has been lit. It came back down 2 days, okay? But the signal is what we trade, okay? And off that signal, it came down 2 days and then it launches, okay? It Model T's, boom, boom, boom. Model T's, it hangs here. The bears thought, well, it was just a little jump. And the bears are thinking they're going to get control again, and they even increase volume, but it's not going to drive much below Model T. And I'm watching that every day, and I'm just like the kid in the candy shop thinking, we've got, the bulls are gaining traction and control of this stock now. And it was happening at a time that was unexpected, a long time before it was supposed to happen. And so, yeah, it just took off then and shot out. And notice it went to a new low below the Model T trend. It goes to this new low, okay? There's your tricksy move, and then it comes back up, and then off it goes, okay? But this move right here, look what it looks like after the fact. Doesn't look quite the same now, does it? Okay? Doesn't look the same, does it? But that's why you have to look at charts daily, because this is what you're trading, and this is what you're trading. Okay, and you will make a lot of money off of that pattern. And I expect you to tell me when you see one going on, so that I can join you. Okay, Uber, we already went through. We went through that. Oh, I went backwards. I see. Okay, here's SPY, same pattern. Okay, SPY, intraday, same pattern. Back, 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 back. Okay, and then here it is right here. Okay, here it is. So here it is coming down, okay? Here it popped up above the 2 minute in this case, instead of the 2 day, days become minutes, things move faster. You're pitching 100-mile-an-hour fastballs on an intraday chart looking at 1 minute. Some people use 30 seconds, I can't, so I'm too old. So anyway, yeah, but I'm watching that, right? And as soon as it goes there, the signal's lit and I'm buying. Okay, I'm entering SPY. It drops back down here and I'm going Model T. Where's my Model T line? And it's right through here. And I'm a believer, so I'm staying and I'm adding, and then it takes off because of this pattern. Okay, this is the confidence builder pattern right here. And you could trade that, and it's a trend setting pattern. So in your notes, put stair step trend setting pattern, because that is a bullish stair stepping pattern. Now, you can reverse it, okay? If you reverse it, if these are going this way in a stair step, it's exactly the opposite. It is a bear wedge stair step pattern, and the stock is likely going to break down. Okay, so that helps you know if you're in a stock and you see that pattern, you start taking action. You start taking preventative action on that stock. Maybe you exit totally, depending on your position and your purpose and your goal. Is it a trade? Is it long term? Everything else now factors in. But that is a ultimate pattern that you want to pay attention to. Okay, and of course, Model T is where that pattern terminated on SPY. If you notice that right there, okay, so if you take the low and you take the high, you add them and divide by 2, here's Model T, it hit it exactly, Trixie move flash, starts up, it came back down and it violated that Model T a little bit, but it held it then, okay? And as long as we didn't lose back down all the way, I'm staying with this trade. Okay, and I went shares on this one. I didn't even do calls. I went shares. Do we know why institutions use controlled stair step before a bull move? Yes, because they want people to believe that the bears are in control, that the bears are starting a sell-off of the stock. And so it's a natural phenomenon that allows them to get rid of day traders that aren't educated before it moves. And I will say there's probably I would say there's only 30% of day traders that understand this concept right here. Okay, they don't understand this. They don't know to look for it. Let's put it like that. So this is something I discovered years ago, and it's held true over and over and over. And you make that a big star in your notes that you're always watching for that, because something's, especially on daily charts. If you're seeing it on daily and those wedges are like this stair step and they're kind of really tight. Not if they're going like this, they got to be, at an angle, kind of like that. And it's amazing what angles mean to a pattern, because angles are everything. Okay, and I think I've got an example of the other type of angle. Here's Big C, and y'all remember Big C, right? I mean, this is post IPO. Here's where it IPO'd over here. It jumps up here to 160. And then it comes all the way back down into the 60s, high 60s, 70s. It makes a move up, okay? It Model T's, hello, it Model T's just right where you would want it. And then it starts back down again. And so clearly, this is going to be a little bit of a period of time that's going on here of back and forth post IPO of trying to find major support. We see it on a lot of stocks. Now, some IPOs shoot to the moon and it's like they don't stop, but Big C, it kind of gave themselves away. And if you notice, here's your 3 volume bars and here's your 3 sell bars, kind of the concept of the goalpost trade almost, right? And here's kind of a mini concept of a goalpost trade right here, right? A little bit different because this is not a stock that has been long term dropping into oblivion and then just sitting and then suddenly a goalpost move. But that same concept you can use to make money. And if you recall, those that traded with me, I made the call right here that it's go time. So we noticed a couple of things on here, right? Here's what I was noticing is that these waves that were occurring, notice how they got shorter. They got shorter and shorter, right? Long, medium, short, okay? As they get short, that tells you it's coming to an end. It's either going to break down and lose it, or it's going to break out and move upward. So I don't have an 8-day. I think I may have just started having an 8-day moving average. I had no 21 that showed on a chart. It wouldn't chart. So I certainly had no 50, and I certainly had no 200. So what I'm going off of is this double bottom move here, as well as the entire line of support. I mean, I've got a line right here of, oh, don't do that. A whole line, where did I go? I can't always forget that I'm not on my system when I show you guys things. Sorry about that. There it is. Okay, so I've got a line of support that's been happening all the way that's really never been violated. Okay, here was the bottom here. This is above it, so that tells you that there's interest here. It gets closer, didn't violate it. Okay, but I watched this volume here, and you have all this negative volume, and it couldn't break it below. I pay attention to that. You should pay attention to that. Big volume spikes that can't push down or up through would be just the opposite. Are things that you got to watch for until confirmation occurs. If this had broken on down after this in future days, then it would have been a completely different read. But because of this happening, combined with this macro bottom that you have of support, you had this one here, and then you had this one, the opposite, okay? Just the opposite. It was its own goalpost move. And so this is where we entered in, and of course that stock shot up to 90, I can't remember, 97, $98 a share in pretty short order after this. Okay, here's what it looked like in intraday on a 5-minute chart. So that volume day that was occurring, here's what the bottom looked like when the low was being hit and the reversal happened. And you're seeing here, this is a 5-minute chart. See right here, 5 minutes. So I've got 5, 10, 15, 20 minutes of it not being able to break down. And here's 5 minutes of this red volume, and it can't break down. Okay, you got to pay attention. You got to have a 5-minute chart. You got to have a 1-minute chart. 1 minute is kind of like the surgeon. The 5-minute chart is like a GP, a general practitioner. Hey, you know, you look like you got a bottom forming there. I can't tell. The surgeon is like, well, I'm waiting to see if I get a Trixie move, if I get a volume spike above on the minute chart. I'm looking at all those things. And of course, when the 5-minute chart confirms above the 2 minutes or the 10 minutes, that's a really strong sign. But that's what it looks like on a 5-minute chart. Well, now I'm going to go down. Here I'm drilling down to a 1-minute chart. And what am I noticing? I see all red. All I have is a red candle on the 5-minute chart. You're probably thinking, oh, this thing's going to tank, right? Wouldn't you? Right? I used to would have. But here is the rest of the story, okay? And you have these huge green buys that went on, okay? Buys here, and accelerated up to the buys. And yeah, this is classic reversal pivot is bull bear fight. That's what you want to see. I want to see commitment from both sides, and someone's going to win. Someone is going to win this fight. And so you're watching this and you see this and you're combining it with your knowledge on a 5-minute chart of holding, okay? And so I'm seeing a double bottom, okay? And I see it break above and I'm entering. I mean, I'm buying. And I'm buying big. And then notice, what do we get? We get Model T, boom. We get the Model T, jumps back up, and then bases. We were home run at that point, and it went on up to finish the day up to the top of the candle, and that's when it continued on breaking out. But note this huge volume increase, and then note the huge volume decrease. Someone has won, guys. Someone has won the battle, and you're looking at this and you're seeing that the bulls have won that battle. And so you trade that until it tells you not to. And that's the beauty of using 1-minute charts is if it fails, I'm only out what? I mean, if I buy in on breaking up above, if I did it here, which is where I did buy, and then I bought again on a double bottom, hoping for a double bottom, I got confirmed here. So I was a fat, happy kid. And I'm sitting there watching for Model T. I got it. I actually did confess. I sold 10% of the shares when that happened. From Model T from here to here at Model T, and then from here to here at Model T down to here. I didn't buy back. I should have. My bad. And then it bases. But notice. Well, I did. Yeah, you guys know, right? What did we do? You guys that did this know. We sold naked puts because the premium on a IPO, when options first come into play and the stock has been making these dramatic moves, you get the IB, the premium value, intrinsic value, it just sends those premiums to the moon. And so you could sell a $60 naked put out 1 month and get like $12. So you would have had a net entry of 48 bucks on Big C, a stock that I had said, I had told everyone I want to own. I want to be in this stock. And the other one was ASAN, if you remember, in the SaaS space, SaaS. So I wanted to be in that space this year. And these are the two stocks that I wanted. So you sold naked puts. Yes, I sold naked puts as part of my strategy because I naturally would buy more shares at $48 as part of my long-term. So I had a long-term strategy, and I didn't expect it to jump up to $98. I didn't know that was going to happen. My calculated entry was based on what I've just shown you guys. Okay, so I sold naked puts, thinking, okay, 48, I would add more shares anyway. So I'm gonna sell naked puts. I'm going to buy calls, and so I look at. Yes, you have to have money in the account to sell a naked put. So if you're gonna sell a naked put at 60 to buy the shares at 60, and you get paid a premium of $12, but the stock falls below 60, you have to have enough money to buy the shares. Most services won't allow you to do that without the money in the account. They'll draw it out of your, but some will let you draw it out of your, I don't use it, so margin. No, do not fall for that. Yes, you would buy back the put when the stock jumps. You would buy back the put because it's making you a ton of money. Now, if you think that a firm base has been set in the stock, you maybe wouldn't. You maybe say, you know, I got 30 days and maybe I've got 18 days left when it jumps up to 98 and the intrinsic value has dropped it from $12 to probably somewhere around $3. Well, yeah, I'm going to buy it back at $3 and pocket the $9 in premium. So you just made yourself $9 more on top of the difference between your entry here in the 62s and your exit above the 90s. Where you got out, okay, and then your options. You know, generally what I'll do if I'm accumulating a stock, I use options differently. I'm going to feather the options because I don't know where the tops are, and I'm going to hang on to my shares because I want my shares long term, and I don't know if it's going to go to 160. Right? Again, right? I don't know. I just knew this is a good stock for a long term, so I have the options, both sides, naked puts and calls, and I'm feathering the calls as it's moving up. Every $5, I feather a percentage of the call options, and I hang on to the naked puts because I'll take the full $12 if you want to give me the shares at 48 on a stock that's showing this type of action. I'm like, I know that there's big bulls buying this for the long term. They're not just day traders doing it. And so I'm very confident in that. So yes, I will feather calls instead of just holding calls and as a trade. So my last sales on those were at about $83. And then I watched the shares, and you could see the top and we tweeted about the top that I was exiting a percentage of shares as well as going covered calls. I didn't buy puts, and if I had, it would have really been a good strategy, by the way. Because it came all the way back down and flashed down to 53 while I was messing with an oil spill and missed it, and was ready to kill someone. So I missed that whole trade entirely. But I know some of you got in on it because you were waiting. Guild, you'll recall Guild, and you know Guild had been in a long-term downtrend. I'm capturing from June to November. Here it is. Dropping all the way down from June when it broke its support You know, I wasn't in it, so if you were, this is when you would want to be getting out of it, or at least doing something proactive. I'm not one to sit and watch my portfolio just go to pot. Okay, so I'm going to take action. I don't care if I lose $1.50 on a put in the big scheme of things, especially if I've made $20 on a share. Why wouldn't I spend $1.52 on a put? It makes no sense to me. People don't take a more aggressive action on stocks that have moved. I mean, MG&I, come on. I mean, what do you want? You make $40, $50 a share, and you're not going to take a preventative hedge put somewhere out down the line that even cost you upwards of $4? Why? Why wouldn't you do something like that? And that's the advanced seminar strategy that'll be the next time. So this double bottom we were looking for on Guild was just a really good trade. We did enter it here, our first calls, if you recall, and it dropped right against us. But I loved this squeeze down into a double bottom, and it was also a 50-day moving average. So this was a 50-day moving average line, and I'm like, it's gonna come down to the 50-day moving average. One of you, I can't remember, very active on the forums, was right there doing basically mirroring every step. And so I'm like adding a ton of calls every time we were testing the bottom down here at the double bottom, and even sold some naked puts, and then it just took off for us. And so we did that towards the end of the year, anticipating, based on this squeeze down that occurred here, just day after day, kind of a squeeze down, and then this flash down, that became the bottom. And that double bottom held, and as long as this double bottom holds, and generally, by the way, I'll take that to a factor of on a stock that's between $30 and $60. I'll do a factor of $2. So I would actually risk that to 55, 30 area and hold, as long as it's a flash. I won't do it on a slow breakdown below. Okay, if it just starts trending down below that, I'm not going to wait for $2 to be lost. Okay, I would have exited the trade, but we added and added and added because everything kept telling us that it was going to hold, and it did. And I love all of these red candles right here, by the way, into that, because you know all it is telling you that the bulls are just sitting back. And when this first green candle came in that day, wasn't a lot of volume. It was late in December. Holidays are there. It was glorious to see that candle on that day start the reversal. Yes, for Twitter. Yes, whatever you're saying. Okay, Gil. Now, so where did we exit the calls? You might recall this one, but why did I post this? I want you to understand the bridge that goes to nowhere. Okay, this right here, huge volume spike, and it couldn't punch through. That's a bridge that goes to nowhere. I call that a bridge that goes to nowhere. Huge volume spikes that can't break out of whatever the selling pressure is. You have to pay attention to that, folks. That is generally a top that is occurring there, at least within the day. Okay, it's not going to, generally you won't see it get higher than that. Sometimes it will, but in general, especially when you get two of them, it doesn't. And it did. It came on back into the $60 range. But when you see these bridges that lead to nowhere, it can't pop it out. And that's what the bulls were trying to do. They're trying to pop that out. And there was sellers at every price point right there, right? So they were like, well, you know, buy all you want. We're going to sell you every stick of Guild that we have, because that was probably a big time trader, maybe even an institutional hedge fund, because they're really good at spotting double bottoms and trading them, that were just taking the trade, and they don't care about long term. They just wanted all of their money, and they probably had millions of shares, and they're just more than willing for you to buy them all. So these bridges that lead to nowhere, when you have these huge volume spikes and they cannot break it out above these highs, then you got to pay attention to it. Okay, so that's a smaller technical, but it is one that you can, if you're in a call or a put, and that call has been running for you, and you see that, you will exit, and you will make a lot of money that you would have missed by taking advantage of exiting at that point. Okay, another pattern, the dreaded H. Okay, the dreaded H of despair, I call it, and we've been seeing a bunch of that over the past week and some days since the market topped, right? So as soon as you have this pattern here of this rolling pattern and it breaks down, then you're on watch for dreaded H. And when that first one forms, you start looking for repeating dreaded H. And when I say you start looking for them, I don't mean that you start looking for them just to be entertained. You start taking action, because the dreaded H patterns, especially if you've had a day or two of selling, when you start seeing these dreaded H patterns, it means that there's a trend that is set up, that is being confirmed right before your eyes if you're willing to accept the data that's being sent to you. Okay, and so this, here was this back and forth, and when it broke down and it V'd, okay, and it made it all the way back up, right? Made it all the way back up right here. It traded back down, didn't even make a Model T on it, traded back up, tried to press above right here. Okay, so it made it here. I was using my finger, isn't that an Aggie for you? So it made it to right here, and then it drops back, it tries again, and it gets a little higher, and then it fails. And that is one big matzo ball of a Model T, and you are not happy. Here's the first two, okay? Here's the breakdown that first led into the first one. Then you had this wave pattern here, and 3 tops, 3 strikes, and you're out. 1, 2, 3. That is a pattern. Put in your notes, and I'm going to send you these slides, by the way, at the end of the seminar. So 3 strikes and you're out. Okay, 3 supports and you're in. So if you get 3 support buys, then you stick with it. But if you get 3 tops, and especially if they're lowering, okay, then it's 3 strikes and you're out. And you don't want to be there. And when you see this big old dreaded H after these two, there was an attempt here by the bulls, and it's a big fail. Then I guess you could even make another big H right there, but then you had just these recurring H patterns. Look at them, just over and over. And so that's the dreaded H. And when you see that has formed, don't fight the tape. Okay, I'm not even trying to pick a spot to buy. Now, I may be watching moving averages, and if I get a stock that's crossing the moving average, I will then hone in on the daily volume and see what's going on that stock, on the 5-minute, on the 1-minute, and all of the, I'll look at the any news that's out there. I'll look at when is your earnings, those type of things. Yeah, I'm going to be cognizant of that, but I'm not fighting the tape. And so I told so many, I just kept saying, why be, if you're smaller, don't have highly capitalized, why are you in the market right now? Go to the sideline. Just go to the sideline. And even if you stayed in, I sent a tweet out, if you recall, and I said, don't just sit back and watch your portfolio just deteriorate lower and lower. Don't do that. The pattern has told you, if you will listen to the pattern and learn that these generally don't just go away, okay? Especially when they're happening day over day. They don't just go away. And the thing about institutions is once they've committed to selling, they're going to sell. They're going to sell off until they get to their pre-planned point of when they're going to reverse the market. And there is not a darn thing you can do about it. And so, if you're a smaller capital and I give you that kind of information, please, at least consider it, at least contemplate about it. But certainly once the patterns are being shown to you, listen to them. We don't have time for that. I got to get to the actual screen. Microsoft, I want to be, this is something, a phenomenon that you'll see, the sideways Darvas box, okay? Here is a Darvas box. It's a beautiful thing that happens with a lot of stocks as well as the macro markets. During a period of uncertainty, it'll move sideways and it channels between a high and a low. Sometimes it can't reach it, but guess what? Draw right through the middle of it and note how many times once it starts, okay, back to a Model T, back down, Model T, okay, from here, you could draw to here, Model T. It's been established, right? From here to here, Model T, it jumps above it. But anyway, I'm trading the meat. I'm buying here, I'm selling up through Model T. Maybe I hold on to a percentage. I didn't. I sold. I just took the easy money because a sideways trend is formed. And so you'll recall I kept looking for it to break, fill the gap at, I can't remember what the number was at this point, but this mid-range. And if you notice, when it starts petering out into this tight range, look how tight it got. The easy money of these ranges are gone because now you get it into this point, okay? And once, so at that mid-range, you're selling. Yes, I sure do. I'm sorry, I take meat. When I trade meat. I trade here to here, and I'm gone. I buy a put here, and I'm gone here. Even though it went all the way down, I'm gone. Okay, I take the easy money on trades. Okay, and that is from the macro support and the resistance within the Darvas box. Okay. Saves me a bunch. So yeah, I'll leave money on the table, but making money is never a problem about leaving money on the table. But once it starts into this tightness, you see this happening, okay? That pennant that it's forming, that tells you it's about to break out one way or another, okay? It's about to get real, and you don't want to miss that real. So all of this is now off the table, okay? You start thinking in terms of, I've got a very tight channel, the 58, 850 and 21 200-day moving average bands, they're collapsing. I mean, you're going to see them wide, kind of wide and kind of narrowing as these moves go, but now they're just getting really tight. And boy, on Microsoft, you just saw them wound up tight, and you could see that on that trade. And of course, Microsoft, when it busted out, it just shot up off of that. So it was an excellent opportunity. So here's AMD, and we're going to go pretty quick here, guys. And you'll have the chart. You'll have this to refer back to the seminar. But you'll notice something about resistance and support. AMD lost set 92. For a couple of days, it kept bouncing off 92 and jumped up to 93, 94. I think it hit a high of 95, but it would come back down to 92. And then once it broke 92, it flashed down here to the 80s. Okay, it came all the way down here into the 80s, and then it starts making its way back up. But look what happened when it hits 92. I mean, if we had the other chart up of the other side of the coin, it was holding, support, support, support. Support, once broken, becomes resistance. And resistance, once broken, becomes support. Write that in your notes, circle it, highlight it, make it a part of your knowledge base, because that's what happens. And once it gets broken, however, if it's going to be a breakout move, because of the length and the longer this happens, if it does break out, the more prominent the upwards move tends to be. Okay, so this is just 92, just over and over and over. And here's what it looks like. Okay, it just looked like this is an intraday chart of that same one later. Okay, and here's what we were looking at right here. It just kept bumping. Oh, I'm sorry, right here. No. Yeah, right here. It had broken above the 92, but it came right back down. And what happens is, again, once resistance is broken, it becomes support. It flashed down below. So if I went back to that previous screen, it busted 92, went up about 60 cents, fell back down, okay, fell back down below, and then it comes all the way back. So it jumped up, it came back down, it flashed below, it jumped back above 92, supporting again now. It became support. And so now it comes back down. It got close to 92 and it became support. It came down to 92 almost. It became support. So now that you've got support established, it became a heck of a good trade. Okay. SPY. We don't have time. I'll write up a synopsis on where I see SPY. Here's kind of where we were when I was telling people sideline, don't worry about it. I was trading mainly only options unless it was a mass accumulation trade. I don't trade when I don't have a left side. I like to trade the left side of a chart. And after a big correction occurs on a stock, then a big correction occurs. I love trading the left side of a chart. It's so much easier. So when we've broken out to new highs, see, we were at new highs here. There is no left side of the chart after here. That was the previous all-time high, and it had resistance, right, which is expected. That's like completing the cup or whatever, V. And so it hit it, and sure enough, it became resistance because it was resistance when it first happened. And so you get a Model T off of this move down to here. Well, how about that? A Model T, it jumps back up to try to retest, can't make it. So this is a period of uncertainty. And then you break out to new highs. And y'all recall that I posted a chart with a line like this when there was no dailies out there. And I did that because that was the expectation of once you break resistance, it becomes support. And so, yes, it jumps back down here and it tested support several times. What a great opportunity to buy, right? At that point. So it's going up, but I'm only trading options because I have nothing to my left side to go off of. I have no gaps. I have no support areas other than what the last support was. I have no resistance marks above me yet, which could happen at any day. And as we saw, once that did happen, it can be, it could get painful for some people. So when I don't have anything on my left, I trade options. And so when you pull up the SPY chart from March of last year, when it just dropped like a rock way down, that's when and a lot of you guys started trading in March of last year. And, that's a blessing and a curse. It's a blessing because some of you have 350% plus return on investment because you got to catch the right side, okay? You got to trade, and a lot of the mirror trades on me that you did were me trading off the left side of the chart. Oh, there's a gap there. I'm going to trade that gap because now that it broke out from that level, I know it's going to fill that gap. Sure enough, it fills that gap. How easy, right? But once I'm above this, I'm flying blind. Really, I feel like I'm flying blind a lot of times. Now, I'm using all of those other tactics and techniques I've shared with you, but I am not nearly as bullish. I'm not nearly as exposed. I'm using mainly options because I'll take a $2 loss. Okay, I would rather lose $2 on Nvidia instead of it dropping $30 in a day. That's just me. Now, Nvidia is a net free stock for us. So again, we're like, well, we don't really care. So, but anyway, this is where I see, this right here is where I see the markets could get to. I don't even know what they're at right now, but I'm sorry, I'm having to get through this. But 365 area just above is where, here's your 50-day moving average. If we violated that, and again, I'm not thinking clearly, so I don't know. If you get into a serious correction, you could see all the way down to 340. So if you guys think you felt pain, all you felt right now is a simple correction within a trend line, frankly. So you're on a trend line. Okay, SPY is at 380 right now. So see, this is where it could go unless obviously they passed the stimulus. We're expecting it to rally Monday. On the House, they didn't pass it yet in the Senate. So sometimes they'll sell off on the House and then buy on the Senate. Yeah, it's crazy. But anyway, this is my macro view right now of kind of what I'm watching, which is why I have 365 hedge puts and I have some 345 hedge puts. Are you placing stops? Where and how do you determine where to place those stops? No, only because I'm mainly in options. If I'm in mass accumulation trades or net free trades, I'm not going to stop out of a net free trade. I don't care what it does. I'm not going to stop out of a mass accumulation trade because I'm actually liking. If I'm in the middle of a mass accumulation strategy, I'm actually liking it, like WWR. So while other traders are doing their thing, we're doing our thing, and they're completely, totally different approaches to life, right? I happen to think mine is the best, and I think people that are following it also are seeing that they're the best. What percentage of your puts versus your portfolio? I will take a running average of a 30-day profit, and I will take upwards of 5% of the profit. So whatever I have profited over a 30-day period, I will use for hedges and give away 5%. And hedges are like insurance on your home or on your car or on your life. You hope to never have to use it, but it's there. And guess what? You still have to pay those premiums. I buy it on some stocks as well as, I'll buy it on specific stocks. So if I see that a correction has started, I'll buy NVIDIA puts, which I did. I told y'all that I did. And I covered them pretty quick because it went down real hard and then it jumps back up when the market went up. I'm not in those, but yeah, no, I'll trade all kinds of puts, but mainly I'll leave my SPY hedges. They're my regulator. They're my monthly premium to trade. They're my monthly insurance premium that I'm not counting to ever see again. I'm paying it just like you do your home, just like you do your car. I'm giving 5% of my profits away to pay my insurance premiums. And as long as the stock market's moving my direction and I'm making the percentages that we're making, then I don't care about that 5%. Okay, I don't care. Neither will you. So once you get in the habit, once you see it work on your behalf, you'll really be there. Do you practice net free on? Yes, we practice net free on options, especially if we have a target, especially new people. If you have a stock that I said, I think that this call is going to go up 200%. Well, when it gets to 100%, you get your money back. Okay. If you're undercapitalized, if you're not independently wealthy, let's categorize it like that, then you get your money back. When it doubles, you get your money back. You do it on stocks, no questions asked. You do it on options, no questions asked. And then you can hold that other 50%. You might end up with a 20% win if the stock doesn't continue on, okay? But you get your money back. If you aren't independently wealthy, you do not take those kind of risks, okay? You leave that for people. I don't take those kind of risks, okay? I'll sell 50% many times on a stock that is, if I'm anticipating 200, 300%, I'm taking my money out of the market because things happen. People run into buildings, okay? Planes can fly into buildings. Presidents can say stupid things. Foreign countries can do dumb things. You have no controls over those. So when a stock is working for you, then don't flub a win. Don't flub a win, okay? These channels here, kind of they're smaller stair steps. I mark these throughout a day, and whatever direction they're going is generally going to be the trend of the market. And you'll see, this doesn't look very good through here, right? But if you do this, guess what? You start seeing a trend, and guess what this did? I mean, this took off and went to all-time new highs, okay? Mark those little things that are happening in the day, and you're gonna win. We don't have time for Big C. SPY, this became a day trade, and if you notice, I do this a lot. I watch these trends. Anytime there's a bounce, I just mark the lines on my chart in the day. This went kind of sideways, so I didn't mark anything. This one went like this. This one went like this. Anytime there's a jump up, I'll go ahead and draw the lines, okay, draw the lines, and then you get this acceleration. Notice how different that looks? You get this acceleration down, okay, and then you get the tricksy move, right? And you get the volume. All three things that I've just taught you in the past 2 hours come together for me to tweet that we just had a bottom pivot. I think you see a bottom pivot. Now, it was a tradable bottom pivot, but it was not the bottom of the macro move down. Okay, it became about a $3 move upwards on SPY, which also sent different stocks up, quite a bit. So if you're using an intraday, okay, on a downtrend market, you could day trade it, okay, but I wouldn't be making your long-term trades on that unless it's a huge V trade that occurs. And when you don't get a big V off of it, it's not over. The selling's not over. Pull up last year and look at the volume, just was so huge and it got even bigger. And then you get the V. Pull up March of last year. That's what you want to look for once the institutions have committed to a downtrend. That's what you're going to see. You're not going to see a pillow fight at the end of a downtrend. You're going to see exacerbation. You're going to see max pain, acceleration, max volume, and they can't hide themselves. What was the same question? I didn't see it, Jay. What's the question? I'm gonna try to. After you're net free, how do you decide when to exit? I look at things like, is it going to complete a cup? Is there a gap to be filled? What's the trend of the macro market? What's been the trend of the stock itself? So is it in breakout territory? Is it running on up above breakout? Those are things that you're going to use to determine just how long you want to hold into a stock. So when I give people targets, what I've done is I've calculated, basically it's a calculated decision that I've made. I've determined based on trend of a stock, based on key elements of either a cup reaching level or if it's a breakout. Generally on a breakout, you have 6 to 8 days of a move upward on a breakout move. 6 to 8 days that you have. MG&I, yeah, right? So you get those breakout moves. Okay. Apple. This was what happened with Apple at the same time that was happening. Okay. And Apple's been the bane of my existence. I had the 129 puts. I had to sell them because they were expiring at the end of the week. They were weeklies. And so, yeah, I mean, SPY closed below 122. So, yeah, I made good money off of them and avoided the loss. I didn't start trading until after MG&I. Yeah, well, there'll be more. Okay, so that's the end of that. Now, for those that want to stick for just a second, I'm going to log in to my Fakey account of Interactive Brokers and show you just a couple of things. And I'll give you my macro read on the market just to end it. Yeah, hang on. I'm turning off the camera. Thank you, whoever that was. I owe you a meal. I think one of the seminars I tried this on was Interactive Brokers was down for maintenance because it was off hours. Did I just show you that? I thought I turned my camera off. Maybe not. I'm sharing my screen still. That's okay. I'll just change my password. Yeah, that was a classic Aggie move. You're totally right. So anyway, all right. So hang on. I want to get over to SPY. Send diagnostics. That's probably from the power outage. Okay, fine. All right, SPY. All right, so here's what we're looking at on SPY. Here's what you want to bring up on your charts. And if you guys are laughing at me still, stop that. So, you know, here's what you're looking at. You got your 8-day moving average, your 21-day, your 50, and your 200-day moving average, okay? So right now, we flashed below the 50-day moving average, right? So in general, when you see like a Scott Redler, and that's his name, that's who was on the Excel, came to me just now. When you see it flashing below here, Scott is always becomes pretty pulls his horns in anytime you're below the 8 and 21. I do too. I was probably ahead of him with my horns being pulled in. I always use the exponential, always. These are exponential moving averages. So I trade down horns. I trade the exponential moving averages. So this is a flash below the 50-day exponential. Look at this volume. So you've got some big volume selling going on that is trying to break it. It is trying to break the wheel here of the market. Now, last time this happened here, right? Here's volume again there, and it turned out to be a big move up into record territory. I think Adam Mancini, who is a great follow, and he's a very good statistician, trades almost exclusively based on statistician technicals. So he's calling for a hold of the bottoms here, and a Randy Taylor is left. Can you guys see me? Can you see me? Okay, I don't know what that message was about. So yeah, he's calling for a bottom to form here. It could get ugly, right, as it does. It could flash down again, or we could hold and move. But he's calling for a move back up in new record territory. That's his best estimate. And you can call it a guess. I don't care. I'm not offended by that. But that's his best calculation. But if it fails, then yeah, I mean, here's your 200-day moving average. If you recall, I have a line right here that I said would be my low based on a gap that's right here. So see that gap? So I would be trading down to this 365 level. And if that's lost, then yeah, your 200-day moving average becomes sink or swim. Still, yeah, big sell-off, but still above the late February. I mean, we're still trending upward, guys. That's the thing. You draw a line, your trend is still upwards. So yeah, this sucks. It's painful, but right now there's been nothing. Now, was it great not to be feeling it? Yeah. I mean, so people that went cash and heeded that, just say, you know, look, if you're undercapitalized, you're not independently wealthy, why not sit it out? Just that's not a bad thing. And if it starts going against you, sell out. Go take a 10%, 20% loss, unless it's a mass accumulation strategy that you have determined as part of your strategy, then bail. Capital preservation is king. If you don't have any, yeah, clove. Unless you believe in clove long term, then and you're just in it for a trade, then you shouldn't be in clove. I'm mass accumulating clove. I'm loving every downturn. People are agonizing over it. I'm loving it. I want to accumulate shares as low as possible. I want to have naked puts at the highest premium possible. So on accelerated down days, that's when I'll enter naked puts, because that's when your IV jumps and I can do it. So if I can get a $7 naked put, that's when I'll do it. And again, mass accumulation on some stocks isn't for everyone. WWR was probably one of the easiest ones you'll ever have. MG&I was, we started accumulating at $8 on that thing, if you recall. We had traded it early, but then once I studied it out, it became an $8 one, and it dropped all the way to $5, if you recall. And that's where we went huge on it, huge mass accumulation. And that allowed us, we traded some of those shares, right? We traded them back up to 7, back down under to 550 or 6 area. We were making money by trading it while we were waiting. And that's what you want to do. I get assigned about 10% of the time on naked puts. So generally they're just money makers. But 10% of the time I'll get assigned naked puts. And again, that has to be on a mass accumulation part of your strategy. I'll probably have a seminar with Jeff that will do a seminar, and I'll pay him on how to use naked puts with very low risk, just to basically bank premium. It's a great strategy. It's almost exclusively his money-making strategy, and why wouldn't you do that? It's a really good idea. So I don't do that because I'm, as you see, I'm very active. But that's my take on SPY. Okay. Yeah, Clove. I mean, if we take a look at Clove, just real quick. Okay. Yeah. I mean, obviously you're in that steeper downtrend. And so what's happening is it's starting to accelerate and you're about to find a bottom. So there's you a calculation. Let's see if this works. It's starting to accelerate in the down. You start having all red because the bulls are just not buying. I mean, here they were, they bought here, right? They bought 2 days, 50+ million shares, and they didn't sell it. Here they are buying. They sold some here, but there they are. Okay, you're getting close. Right? You're starting to get close, but they don't care. They don't care about you. They don't care about your agony and losing sleep at night. They just don't. Okay, and either you believe in the stock or you don't. But we have this huge gap right here. Here is where it's going to go when it reverses. Another calculation. So once I see the reversal happen, I'm going to be buying $13 calls. And something cool, that's advanced strategies, don't have time. But on this platform, when I talk to you about the, you know, you don't have to sit there and do, oh, good grief. You don't have to sit there and do, well, let's see if I can get it. You don't have to sit there and do your calculations. Watch this. Here we go. We're going to pull. This is the last thing I can show you right now, guys. Okay, I got to get a vacate. So edit. If you go on, if you have IBKR, okay, and you go to edit and you go to Fibonacci retracement, okay, and then you just take the low where it started and you take the high and you draw that, it's going to draw it. Here's your 50, there's your Model T, is this yellow line right here, and we're flashed below it. But did we reach it? Yes. Is that part of my formula of why I was telling people it's not a bad idea to be sitting out? Yes. Okay, because right here, I was convinced we're going to hit Model T. Okay, that's all it was. It was just, this isn't rocket science, and I want you to be able to trade with confidence. I want you to make money, and so that's how you do it. Model T has been achieved. How far down below? This flash almost reached back up. Now a Model T, and it tells you what it is, 381.41. Okay, so 381.41, if we're not above that right now, it's going to be a little bit of resistance, because once you break a Model T, it becomes a little bit of resistance, but if it quickly breaks through there, that's a pretty good sign. Okay, so Model T, if I did one Fibonacci from here to here, I'm going to get a Model T. All right, these things are gold to you. And again, this is, it's under edit and just Fibonacci retracement, and then you just draw, click at the bottom of one, click at the top, and it'll tell you where your Model Ts are. And so yeah, I had some short-term puts that were to Model T, cashed in on them. I'm out of them. But that works on every stock. I'm telling you, you will prove it to yourself very quickly. Okay, here's what I want you to do. I want you to send me questions. I want you to send me clarifications. I have different trade for different retirement accounts. Yeah, I have different, yeah. My dad's account, I handle his account, and I almost exclusively have a covered call strategy in his account. In fact, when I bought E-Bond at $5, I sold a $7 covered call on it. And so when it jumped up to 10, 11, you know, dollars, and I'm like, I don't care. I did it on 50% of his shares. When it jumped up to above 10, I sold 50% of his shares. He's 84. I'm not going to do a mass accumulation strategy for my 84-year-old dad. So yes, your strategies change based on variables and factors, but all of the tactics and techniques remain the same. Okay, when to enter, what to look for, how to spot opportunities, knowing when to hedge, all of those variables, those don't change. Okay, so I want you to send me questions and clarifications that you need. I will be sending you all of the charts that I just presented, and they have the verbiage on there. Some of them, most of them have a telling you what you're looking for on there. So if it's a Model T chart, hopefully the goalpost chart are self-explanatory, but I did write that on some of them. All of the tactics I wrote on those slides so that you'll have them. So I'm going to send those to you, and you'll be in a really, hopefully you found this to be extremely valuable. I also crave your feedback, as well as how it could be better for the next segments. And future segments, I have more interaction. Hang on, I can't read without. Just in my 4th week of trading. Don't even know what question to ask. Well, then if you're new, just started trading, then my advice would be that is not advice from a professional trade or a Series 7 person, but just me as a professional trader. My suggestion would be to start drawing Model Ts yourself. And improving the theory, okay, proving the fact that happens over and over and over. Start looking at the patterns that I've just shared with you, and start doing it on the daily charts. See it first on the daily charts because it's easier. It happens in slower motion. It's a 60-mile-an-hour pitch, okay, and then move to a daily chart with the 5-minute chart. And you'll see the exact same patterns. Every single pattern that I'm giving you works on daily charts, and it works on your intraday charts. And so you just refine that process, and you'll become a much more accomplished trader. With that, wish everyone happy trading. I'll be seeing you in the virtual world, and we'll also be setting up another seminar. I'll probably do a couple of more, and we'll be talking to you then. All right? Gig 'em. Thank you, guys, and I'm changing my password right now.
Gig 'em.